Hi guys, and welcome to Cultnomics. My name is Paul Hanley, and today I'm going to be chatting to you about
Central bank monetary policy. In this video, we're going to look at the operation of monetary policy by a central bank and how this controls the money supply and indirectly interest rates in the economy. The first tool of monetary policy is standing facilities, and these are facilities that if a commercial bank, a retail bank, goes to look for money, short term, maybe overnight, they're charged a marginal lending rate by the central bank in question. So commercial banks can lend at this quite low marginal lending rate overnight if they're short of funds. They can also go to a central bank if they have excess reserves, and they can deposit this money in a central bank at the deposit rate, and they can earn some interest off this. So the central bank acts as the banker to commercial banks. The second tool of monetary policy is reserve requirement, and what this means is that it is the minimum amount of reserves a bank must hold in liquid form or cash form as a fraction of total deposits. So how does this work? Well, if an individual walks into the bank and deposits €100 cash into this bank, the reserve requirement, or the reserve ratio, for example, is 10% set by the central bank. What this would mean is the retail bank would keep €10 on reserve as required in case an individual came back in to take out the money. So this is the minimum amount they'd have to keep in. It's generally held as reserves in their current account at the central bank. So that's the second tool. The third tool is open market operations, and this is the buying and selling of government bonds. So the definition is it's regular liquidity providing reverse transactions, generally with a frequency and maturity of 1 week. So what is it a reverse transaction of? Well, it's a transaction of a government bond, not directly issued by the government, but bought and sold in secondary markets. So if the central bank purchases a government bond, it is like as if it's injecting cash into the banking system, and this would increase the money supply, and we'll trace this out in a minute to see the impact on the economy. If they sell government bonds to financial institutions like banks, they reduce the money supply in the economy. So this is a negative effect on the money supply, a reduction in it. So how does this actually work in practice? Well, we have a central bank that is the head of a network of small retail or commercial banks. So a central bank may purchase these government bonds from a banking institution, or it may sell them to the banking institution. And in this case, the bonds will exchange hands for cash, for money. And this will either increase or decrease the reserves of the banks, and therefore increase or decrease their money lending. So this will not just happen one time, this will happen across a number of different banks within the network. It will happen every week or so, these repurchase agreements, where the central bank purchases for a week-long period, 7 days maturity, and either injects or takes money out of the system in that case. So what a bank can do is directly control the money supply in that way. There's two ways they can do it. They can use expansionary monetary policy, which is when the central bank purchases government bonds from a bank. So the purchases here are like an injection of cash into the system because they're paid from the bank with cash, so they increase the bank's reserves. So the banks exchange these bonds for cash, making them more liquid. With that increase in reserves, what they can do is they can increase the amount of loans that they provide to borrowers. So in this case here, the potential loans increases, and we've seen this in another video called money creation. And when the potential for bank loans increases with more cash and with higher reserves, what this leads to is an increase in the money supply. And when the money supply increases in the economy, the impact it can have on interest rates is it can decrease interest rates and therefore decrease the cost of borrowing. And this acts as an expansionary monetary policy in the economy. So borrowing increases and expenditure increases. We can visualize this in a money market demand diagram where we have the interest rate up on the y-axis and we have the quantity of money down here on the x-axis. We draw in a money supply curve which is vertical. It's independent of the interest rate, so it's controlled by the central bank, and we have a downward sloping money demand curve telling us that as the interest rate drops, the opportunity cost of holding money drops as well, and therefore money demand increases. So downward sloping money demand curve. Where money supply equals money demand in equilibrium, we derive from this the interest rate in the economy, the equilibrium interest rate, and we also derive from this the equilibrium quantity of money as indicated on this graph here at point A. So for looking at expansionary monetary policy, we said that the money supply would increase, and we show this by a rightward shift of the money supply curve to money supply 1. In this situation here, the equilibrium interest rate and quantity changes down to point B. So this is the new point where money supply equals money demand. At this point, what we see is an extra supply of money, expansionary fiscal policy, decreases the interest rate from I to I1. So this reduces the cost of borrowing and also increases the quantity of money in circulation. So this is a form of expansionary monetary policy where interest rates drop and borrowing increases in the economy and the quantity of money. Now, we can also look at the opposite policy, which is contractionary monetary policy. And in this case, what the central bank does is it sells government bonds into financial markets and institutions, in this case, a bank. So to contract the money supply, they sell government bonds. And in this case, if banks are buying them, well, what will happen is the banks will use their reserves, their liquidity, their cash to buy these bonds. Bank reserves will decrease, and this will reduce the potential of commercial or retail banks to lend money because they have lower reserves and they need to keep a minimum amount of these. So the decrease in the potential bank loans has an impact on the money supply, and the money supply is going to increase in that case. So money supply goes down as soon as potential bank loans go down, and when money supply decreases, it has an inverse relationship with the interest rate. So the interest rate will increase in this case here. So an increase in the interest rate, increasing the cost of borrowing. Once again, we can show this on a diagram, the money market diagram. And what we see here is, as before, we have the interest rate on the y-axis and we have the quantity of money down on the x-axis. We have the same curves as before. We have a vertical money supply curve showing us that the interest rate is independent of money supply in terms of central bank control, and we have our downward sloping money demand curve as explained previously. The equilibrium point is point A, where we derive the equilibrium interest and the equilibrium quantity, where money supply is equal to money demand. So this is shown as I on our graph here, the equilibrium interest rate, and Q, the equilibrium quantity of money. Now, what we see is with contractionary monetary policy, the money supply curve shifts leftwards. That's a contraction in the money supply. What happens here is with money supply 1 on our graph, the new intersection point with money supply and money demand is at point B, and at point B the interest rate has increased. So this is contractionary monetary policy where the interest rate increases to I1 as shown. So the cost of borrowing has increased, so there will be less borrowing, potentially less expenditure in the economy, and also Q1, the quantity of money in the economy, has decreased as well. So there's a decrease in money supply and an increase in the interest rate. So this is contractionary monetary policy. And the overview here is we can have either expansionary or contractionary monetary policy in the economy through the purchase and sale of government bonds.
I hope you call back to Cultnomics soon. Bye for now.